For more on this, we're joined by Tim Waterer in Sydney. He's Chief Market Analyst at KCM Trade. Welcome back to the programme, Tim. Now, firstly, is it the risk of inflation that's keeping markets on edge at the moment?
Nice to be with you. Yes, that's essentially what it boils down to. I think traders are looking at these high oil prices at the moment, trading above triple digits on Brent and US crude, and basically drawing a direct line to high, interest rates to try and cover off any inflationary effects that could occur. So yes, I think we're seeing a repricing of interest rate expectations around the globe, not just from the Federal Reserve, but also in Europe and Asia as well. So I think that's what's keeping markets on edge at the moment, is that the longer these high oil prices stick around for, the more inclined or the more necessary it may be for central banks to hike rates to try and contain inflation.
And how have these market swings created opportunities for investors to rebalance their portfolios for long-term returns?
There's a lot of volatility going on at the moment, so there is short-term opportunities there as well. We are seeing some typical moves that have happened since the conflict began. One is the inverse correlation between high oil and lower stocks, in particular the S&P 500. Now, that did break down a little bit, that correlation last night. Interestingly, both oil and stocks went higher, and I think that shows differing expectations from the energy and stock market as to how this upcoming deadline from Trump to Iran may play out. But in terms of opportunities, I think, yeah, you're right, we are seeing a bit of a reshuffling around. Gold has come off quite a bit. Now it's starting to represent maybe a bit of a value proposition, but gold is having a bit of a hard time rallying because of that high oil price at the moment. So it is really, we don't really yet know whether oil's sort of, heading at 140, 150, or if it comes back to 80 or 90. And I think it all comes down to how this deadline fares from Trump in the next 24 hours.
And with only a handful of vessels passing through the strait at the moment, what's the worst case scenario if the deadline passes without a deal?
So if Trump does target further infrastructure, including energy infrastructure in Iran, of course, that could further detrimentally affect global supply of energy. And of course, Iran, they could respond in kind by targeting other infrastructure around the Gulf region. So I think that's what could further create pressure and choke the global supply chain and put upward pressure on prices. And I think that's why we're seeing crude prices edging higher today, but they're not going through the roof yet. And that's because there is still a window of opportunity, a diplomatic window for some sort of a ceasefire to occur. So markets sort of hedging their bets a little bit at the moment, but certainly $140, $150 barrels of oil, that is a viable outcome should things escalate further after this deadline from Trump.
Right, and markets had been pricing in 2 Fed rate cuts for this year before the war kicked off. That doesn't seem likely now, does it?
That's right. That's really off the table at the moment based on where things stand right now with where oil prices are at this point in time. So markets, they're sort of leaning towards either no cuts at this stage or maybe even one hike later on this year from the Federal Reserve. So how long these oil prices remain elevated for, and by that I mean above $100, I think that'll dictate whether US inflation sort of goes towards 3.5%, 4%, or maybe even higher, 5%, 5.5%, should we get the worst case scenario, let's say, regarding this deadline and further targeting of infrastructure around the region. So yeah, certainly that pivot in terms of expectations for interest rates from the US, that has put a dampener on things as far as stock market and risk assets are concerned.
And what specific industries will be impacted the most by this?
Yeah, I think what we're seeing is that in terms of the stock market, we are seeing a bit of a rotation into more of your cyclical stocks or defensive stocks, such as the utilities, for example, or healthcare. So areas that deliver a reasonable yield, but certainly don't shoot the lights out when things are all going well. So we are seeing that rotation playing out at the moment. But if we are seeing these high oil prices, that from an economic point of view, that puts pressure on transport. And eventually we expect that the high transportation costs, they'll find their way through to the supermarket shelves and put pressure on consumers and retail sales, extension of that, and maybe force central banks to hike rates to contain inflation. So a lot of bad scenarios that could emerge should things escalate from here. So a lot riding on what happens before this Trump's 8 p.m. deadline coming up.
Tim Waterer in Sydney, thank you very much for your analysis.